Hey, folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This Weekend Technical Analysis Update is for Monday, November 8th through Friday, November 12th, 2010. Let's get right into the charts here, folks, and get started. First off, we have to look back at last week to make sense of it all before we can project into next week. Number one, last week was a very slow starter. Why? Because you were waiting on the elections, the Federal Reserve QE2 policy, and how much money they were going to infuse into the markets, and then ultimately we were going to see where that would take us towards the end of the week. Obviously, based on the fact that the Fed has a weak dollar policy and wants to flood the markets with tons and tons or billions or trillions of dollars, that means you have to anticipate they're going to come out with a lot of QE2. That's exactly what they did. Remember, the market is pure and simple a nature or asset bubble in creation. And I want you all to understand that because it's so important. I mean, we talk about asset bubbles and think, oh, that's not a good thing. But the Federal Reserve, that is what they're trying to do. All right, finally, the media is picking up on it. We have said this for months now. Since this rally began, we said, listen, this is an asset bubble. They're trying to create this. Whether or not they succeed is another story. But you have to understand the Federal Reserve is thinking in terms of inflate asset prices, meaning stocks, commodities, everything, including hopefully housing. That's what they're thinking, although I don't think it's going to work with housing. But inflate them all. The average American is going to see their 401k go up, hopefully their house go up. They're going to feel richer. They're going to go spend. The spending then creates a recovery in and of itself, and again, the cycle goes round and round. That's their thought process, folks. Now, many of us can judge whether or not that's appropriate. Is it right? I don't know. Bottom line is you have to figure there's major inflation down the road that we're going to have to deal with. Will the Fed be on the cutting edge of dealing with that inflation? Most likely not. All right, the Fed has never been on the cutting edge of anything. Thus, you can see pure and simple the financial problems we've had over the last couple of years. They were definitely not on the cutting edge of that, or they would have seen it ahead of time and not created such a master kind of crushing of the overall economy and the global world. All right, so again, you can look back at the housing bubble. They obviously weren't ahead of that, or that would have never happened. Financial collapse, weren't ahead of that. Had to deal with that after it happened. So, what makes you think that they'll be on the cutting edge of this? Nothing really. So, we're just creating another bubble that will have to burst, and each bubble is getting bigger and bigger. Remember, the technology bubble burst in 99, 2000. It kind of topped out in early 2000 or mid 2000 and collapsed. What did they do to combat that after it was already done? They lowered interest rates to basically zero, then created the free money situation. The lending rules were cheapened or lessened. That created the housing bubble and the financial crisis. So that bubble was then created. That bubble was bigger than the tech bubble, as we all know. The recession now is much, much bigger than the one in 2001 or so. All right. So understand that. So the theory goes that if they're doing what they're doing now, which is creating another bubble, you're creating the next bigger bubble. I mean, don't even think. I mean, it's a scary thought to think about how much bigger a bubble can be than what we just went through over the last few years. But that is what's going to happen. And granted, it won't come along for a couple of years. You're going to have 3 or 4 years probably before this happens. You'll have 3 or 4 years where inflation remains low. But when it starts to tick up, when you get a treasury collapse, when you get people saying, I'm not lending the U.S. any more money, and the Federal Reserve is then tapped out. Because we remember, the Federal Reserve is replacing some of the debt that China is buying. All right, China's not buying as much because they know our weak dollar policy. They're losing on that trade. All right, when China buys $100 billion in U.S. debt, when the dollar drops 10% in a matter of 6 months, they've just lost 10% on their investment. All right, understand that, folks. Very important to understand. All right, I mean, that's the thought process here. Let's get into the charts. Early last week, again, you could see the markets clearly right here, gapping up a little bit on Monday, but then reversing to the downside. People were a little skittish ahead of the elections, and again, ahead of the QE2 Federal Reserve FOMC policy statement. Markets end basically flat, though, and you can see right here, I remember calling this, we were trading right around here and beginning to collapse in the intraday video, which is free on our blog. I said basically, this market's going to close flat. The market was down here about 50 plus points on the Dow, and then it roars back to close flat. No brainer, folks. Remember, Federal Reserve, it was in control, especially before elections. They're not going to let this market drop on elections. You have to understand that. They were never going to let that happen. All right, you have to understand the connection between the Federal Reserve and the government, especially the leading party right now, or the Democrats. They were not going to let the Republicans take over all the House and the Senate. It just wasn't going to happen. All right. The way you keep that, or keep the swing voters, the voters that aren't quite sure, in check, you make sure the market at least closes flat, and then the day of elections, keep the market up. That's exactly what they do. And then again, you hopefully turn a couple of those swing voters who are unsure towards the Democratic Party. That ended up happening. You still got the House taken by the Republicans, but the Senate stayed with the Democrats. All right. So market goes flat on Tuesday. This is all in anticipation of QE2 on Wednesday. Wednesday, the market starts out and sells a little bit as people say, you know what, I don't want to risk it into this announcement. The market then gets the announcement at 2:15 p.m. Eastern time, folks. And when this announcement came, initially it sounded like $600 billion, which was basically $70 billion a month, $75 billion a month infused. Market was expecting $100 billion. But then another announcement came out saying right afterwards, basically within 20, 30 seconds of this, maybe a minute or two after, as they were going through the policy statement, saying that we're now going to take some of the dividends that have been created by other stuff, which is another $35 billion a month, and infuse it into the market. So now all of a sudden the market gets 105, 110 billion per month. Market loves it. Market starts to rip up. So you can see right here down, and then a quick move to the upside, and a monster move to the upside. Markets end positive on the day. The next day the rally continues with a monster gap up. We go higher and higher and higher. We take out the 122 even number after hitting it multiple times. I gave that as a key level last week in the weekend video. 122 was. You can see it hammered it, hammered it, hammered it. Then we closed above it. That created another situation where we were going to go higher. You went to 123, the even number, and then pulled back a little bit and kind of chopped around on Friday. Friday was generally a flattish day to slightly positive as anticipated. Remember, Fridays are almost always neutral to positive. They never let the markets drop 300 points on Friday because most people, most average Americans, do their shopping on the weekends. Therefore, you can't have or can't expect the economy to recover when no one shops on a weekend. And what do I mean by this? Take a look at this, though, folks. Let's do this little analysis. What if the markets drop 300 points on Friday? How many people think that the average person is going to feel comfortable going out after they just heard the market drop 300 points and things are getting scary again and going and buying that new big screen TV or that new couch, that new bed, or that new house? It's going to be stalled out. So you create a flat to up market by manipulating the markets on a Friday. You keep people out spending. All right, if you're going to let the markets drop it early in the week. Drop it on Monday, Tuesday, or Wednesday, and then kind of Thursday's okay too, but you always want to have that flat to neutral or positive day on Friday. Get those people out spending. It's all a manipulated game. If you don't understand the game, you're missing out. You're going to end up getting hurt in the markets. Understand the game. All right, I can't stress that enough. Don't keep your head in the sand, folks. Those who keep their head in the sand will ultimately get crushed when the next bubble collapses, which, again, you can make money here on the long side in the short term, probably, although I do think the markets are due for a pullback, even though the Federal Reserve will continue to pump POMO, permanent open market operations, into this market. All right, and again, let's go over the charts here now. We'll go quickly to the 60-minute here. You can see this was the trend lines we were hovering. Look at these two trend lines, this one and this one. Market could never break below this lower one, and then finally they just rallied up. And again, you have a little bit of an in-spirit of bullish pattern here. But again, one thing I would say, folks, it's all about the dollar at this point. Does the dollar go lower? If the dollar goes lower, market goes up. The Federal Reserve is in control of the dollar, so if they push it down, they'll push the markets up, at least in the short run, until something spooks the market. You're looking for that spook. Are we looking for that kind of next shoe to drop, in other words, that kind of makes the Federal Reserve lose control? Remember when China raised interest rates, a surprise interest rates raise, that's when the markets freaked out a little bit just for one day, but that just shows you that the ability of something any bigger could have a longer lasting impact on this market. All right, daily chart continues to rally up here. By the way, W inverse head and shoulders pattern has almost played out here. 124 is your ultimate target on that, and again, that's not too far away. In fact, we took out the 2010 highs on the SPY here. Dow and NASDAQ have long ago taken those out and continue to rally up. All right, let's go to the dollar quickly. Dollar continues to get hammered here, folks, and as long as you see this big drop, I mean, look at this. Back in July, folks, how high the dollar was. Dollar was near 26 on the UUP. It is currently hovering at 22. That's a huge drop, folks. I mean, you're talking 15+% drop here on the dollar since mid-year. And remember, that means that technically in your portfolios, if you've gone up 15% or 20%, you've basically made nothing. Because again, if your buying power, if your dollar is worth 15% less, but you have 15% more, net it's even. So, I mean, you have to understand what's really going on here. They're trying to create this false sense of a reality where you get this sense that there's a recovery because your 401k is going up and all these other things, but it really isn't. Now, granted, do they think that it's going to create a recovery because you're going to be kind of the average American's going to be stupid enough to go out and blow money and go run up crazy amounts of debt? Yeah, I mean, that could help, absolutely. And it's going to help the recovery, of course. All this Fed money infusion will help in the short run the economy. We think we're seeing it in the economic numbers with a good jobs number on Friday. But in the long run, will it have a sustaining effect? That's the bigger problem. And what's the downfall here? What's the bigger bubble that's going to be created? All right, let's quickly go over projections for next week, folks. I have to go back to the spiders here. Again, 124 is your outlook for the spiders as a high level. If that hits this week, that's a completion of the inverse head and shoulder pattern on the daily chart. So that's number one. If you go through that, then 125 would be your next spot of interest on the daily as well. Anywhere between 124 and 125, you probably look for some stall out. Again, I wouldn't be surprised if you have a little hangover effect this week early in the week. Market does not have a ton of economic news. It has some, but not a ton. Earnings, again, are mostly over at this point, so kind of put that away and put that aside. Now it's going to be all about the dollar, getting back to that dollar. And again, the Federal Reserve with their POMO is going to do their best. All right, again, keep an eye on this. If the market starts to fall, just follow the trend lines on the charts. You can see you have gap fill, you have gap window, you have this white trend line right here at 122. These are all key trend lines on the way down. If by chance you got below last week's lows down here, that would be a very bearish signal for this week and a major possible reversal and top put in. All right, have a great rest of the week. Remember, join the Research Center, folks. Research Center includes everything. We're launching the new website this week. We're launching our key affiliate program for those websites out there that want to participate. We have new things coming down the pipeline, more and more. You want to get involved. The plays will be out there. The money will be able to be made. Let's do it this week. Let's rock it. Take care.